Sure. I work at EIV Capital. I'm managing partner there with another co-managing partner. We focus on growth equity and infrastructure investments. So that's across the full value chain. Our investors expect us to invest in infrastructure that can create a cash flow profile that generates a return back to them. And that's inclusive of both traditional energy infrastructure, but also energy transition infrastructure. And both are areas that we've been investing behind for over a decade. Yeah, when we look at portfolio construction, what we tell our investors is we like a combination of both. So if you think about more mature traditional natural gas infrastructure, you've kind of gone through a lot of the growth phase associated with that infrastructure, but it's got a great free cash flow yield. So as we think about portfolio construction, if you can marry that yield from traditional assets with the high growth potential out of transition areas, that can create a better blended return relative to upside, and especially when you think about risk mitigation to downside. Yeah, we do 8 to 10 investments per fund, so we're a much more concentrated portfolio. We spend a lot of time with the companies that we invest in. We want our portfolio companies that we partner with to use us as a resource for them. So when we think about transitional versus traditional, we kind of view it as the same. These are all investments that need to make money. And so if you look historically across all of our portfolios, we've put almost a third of our capital into transition, and that's going back to our first fund. So when we're talking at an investment committee level, or if we're talking as an investment team around a new opportunity, we don't differentiate a whole lot between the two. We're looking for things that we can put into a portfolio that can create that return, and we're not looking to take venture risk. So within energy transition, there's a lot of areas of energy transition that are more venture-like in nature. We look for areas that can touch the traditional, like that can marry up the infrastructure that's already in place with maybe switching out some forms of traditional hydrocarbons for renewable or sustainable fuels. So we don't want to take technology risk, but we are willing to take kind of market adoption risk. A lot of investors are wary. They went through the unconventional boom in the 2000s and 2010s. And honestly, a lot of people lost a lot of money because there were a lot of promises made that weren't kept. So they kind of view transition as maybe another extension of that within energy. Because for the most part, a lot of the same people are making the same promises. They look at our kind of track record of deals we've done in the past and successfully monetized and say, okay, this is a firm that's actually been there, done that. And we're not trying to stray too far. Transition will take decades. We don't need to be the bleeding edge of transition, but there's a lot of in-between area where if you marry focus, technical expertise, operational expertise, and capital, you can actually create a very good outcome for our investors. We've invested behind a renewable natural gas business that's been focused on creating environmental credits in the California regulated market. So effectively, it's a form of sequestration, and we get valued based on the amount of carbon we're extracting out of the air. Our view is that that is going to become a larger and larger market. As you think about people trying to hit net zero, it doesn't mean they're not going to consume carbon. They're going to need offsets, or they're going to need other ways in which they can actually reach their goals, whether it be anywhere between 2030 and 2050. To do that, if they're short the mechanism to become net zero, that means they need to be buying the long exposure from someone else. Our view is that that market can be as big as the oil and gas market globally, especially with the number of companies that have set net zero mandates. There are a number of regulated markets, whether it be in California, whether it be in Europe, that feed into this offset mechanism. And as a firm, we we actually see that as a great opportunity. We're wary of the buying into a belief that the voluntary markets in themselves are going to be able to substantiate capital flows into the space. Our view is that you're actually going to need that to become a regulated market, not because you need regulators to create a market, more to do with the veracity of the offsets. So if big companies, investment grade companies, are going to say, okay, I'm going to pay you to reduce the overall carbon footprint, they're going to want to make sure that's very verifiable. And that's where a regulator can step in between. And it's hard for voluntary markets to be able to do that on their own. If you look at the voluntary markets in carbon today, those markets have gone down, over the last 12 to 18 months have gone down up to 50+% from a price perspective. But if you actually look at the regulated markets in Europe and cap and trade in California, those have actually gone up. The price of carbon offsets that are verifiable are becoming more valuable. And so I think if you've got a regulator that can actually verify them, over time they'll become more and more valuable.